Welcome to The Deep Dive, your go-to for unpacking the latest earnings calls. Today, we're taking an in-depth look at General Motors' second quarter 2025 results and what they signal, not just for GM, but really for the entire automotive industry.
Yeah, we've gone through the whole call, the transcript, everything. And there are some really compelling takeaways, from navigating these pretty significant tariff headwinds to their strategic shifts in both the traditional internal combustion engine, ICE, and the electric vehicle, EV markets. GM is definitely a company in motion.
Okay, let's unpack this now. We'll start with just a quick overview of their key financial numbers. Then we'll dive much deeper into the underlying operational stuff, the drivers, and the strategic directions they're taking. And finally, we'll try and connect all these dots to understand what these results could mean for you, maybe as an investor. So let's kick things off with those top-line numbers for GM's second quarter of 2025. The company delivered a record total revenue for the first half of the year, hitting an impressive $91 billion. Now, what really stands out here is that North America was just a huge contributor, also setting a record at nearly $77 billion. That's a powerful signal of strong demand in their home market, isn't it?
It absolutely is, yeah. That kind of revenue growth, especially in North America, really points to robust underlying demand for their products. Now, if we shift over to profitability, adjusted EBIT for the quarter stood at $3 billion. The headline number, though, it shows a $1.4 billion drop year over year. And here's the critical piece of that. A significant chunk, about $1.1 billion of that decline, was directly down to the net tariff impact.
Wow. Okay, so $1 billion hit just from tariffs alone. That's substantial. What about cash flow?
Right. So adjusted automotive free cash flow came in at $2.8 billion, which is down $2.5 billion compared to last year. And again, tariff payments were a major factor here, alongside some, working capital dynamics, which is essentially how they're managing their short-term money assets and liabilities. But despite these big headwinds, North America's adjusted EBIT margin was still a solid 6.1%.
And here's where it gets particularly interesting, I think. If you actually strip out that tariff impact, that margin would have been around 9%. That's right within their pre-tariff target range of 8% to 10%. That tells a story of fundamental strength despite all these external pressures, wouldn't you say?
It certainly does, yeah. That adjusted 9% margin, without the tariffs, it really shows their core business in North America is still highly efficient, still profitable. And beyond North America, GM International delivered $200 million in adjusted EBIT. That's a strong increase, mostly driven by better profitability from their China equity income. That's a good sign, given how competitive it is over there. And GM Financial also had a strong quarter, chipping in $700 million in adjusted EBIT, earnings before taxes. So another steady profit stream.
And finally, on the numbers front, they're still putting cash to work for shareholders. They completed that $2 billion accelerated share repurchase, took another 10 million shares off the market, and started buying back shares on the open market again in early July. It's clear they're actively managing their capital and sending a confident signal.
Indeed. Those numbers, when you sort of unpack them, they paint a picture of resilience, definitely, and strategic adaptation in what is, a really dynamic environment. What's fascinating here is that the $1.1 billion net tariff impact in Q2 was actually slightly less than they expected. However, they are anticipating higher net tariff costs in Q3, but their full-year gross tariff impact estimate remains unchanged at $4 to $5 billion.
So a big number still.
Yeah.
But they're not just sitting back and taking the hit, are they? How are they planning to mitigate this?
Mm-hmm. Absolutely not. No, GM is pretty confident they're on track to offset at least 30% of this impact. How? Well, it's a combination of things. Manufacturing adjustments, targeted cost initiatives across the whole business, and importantly, maintaining consistent pricing on their vehicles. This isn't just about, hacking away at costs. It's about smart operational shifts. And this whole strategy is significantly bolstered by a massive $4 billion investment in their U.S. assembly plants. This isn't just a number. It's really a strategic move. It's going to add 300,000 units of U.S. capacity specifically for their high-margin stuff, light-duty pickups, full-size SUVs, crossovers. The primary goal here is sort of twofold. Greatly reduce their tariff exposure by building more vehicles domestically and, at the same time, capture unmet consumer demand for these really popular high-profit vehicles.
That's a huge commitment to U.S. manufacturing. When does this new capacity actually, come online?
Well, this new capacity starts coming online surprisingly fast, actually, in just 18 months. And once it's fully scaled up, their projections suggest GM will be building over 2 million vehicles in the U.S. annually. This also provides really crucial built-in flexibility. They can shift between ICE and EV production based on what the market actually wants, which is a critical advantage in what's becoming a slower growth EV market.
That flexibility point sounds really key. And on the market share front, it looks like their products are really clicking with customers right now.
Yeah, their market share performance, it just underscores their product strength, unequivocally. GM's U.S. market share hit 17.3% in the first half of the year. That's a substantial 1.2 percentage point increase year over year. And just to put that in perspective, that's more than double their closest competitor's gain. And here's a critical point. This share gain, it came from strong product demand, not like aggressive pricing. Their incentives stayed well below the industry average. Their crossover portfolio in particular is just delivering record results. The Chevy Equinox gained nearly 6 points of retail market share in its segment alone. It's clear that while tariffs are a headwind, their core product strategy, focusing on those popular and profitable vehicles, it's working.
That's a pretty powerful statement about the strength of their traditional lineup. But the big question for many investors right now is still their electric vehicle strategy. How are they navigating that space? It's increasingly competitive and maybe seeing slower growth.
That's a great question, yeah, because while their ICE business is strong, the future is clearly electric, or at least significantly electric. And they're making some notable progress there. In China, for instance, their new energy vehicle NEV sales saw a second straight quarter of year-over-year growth. And what's even more remarkable, really, is that GM was the only foreign OEM original equipment manufacturer, the car company itself, to gain share and report positive equity income in that incredibly tough market. That's a strong indicator of their strategic positioning there.
And here in the U.S., domestically, we're seeing strong movement too, right? Chevrolet is now the #2 EV brand.
That's right. #2 EV brand in the U.S., thanks to strong demand for the Blazer EV and the Equinox EV. And Cadillac is making serious inroads too. It's now the #5 overall EV brand and the luxury EV leader. That's driven by the launch of the Escalade IQ and really high conquest rates for the Lyriq and Optic models. And for those maybe unfamiliar, conquest rates just means that they're successfully pulling buyers away from other brands.
So it seems they're hitting the mark with compelling products in key segments, building on that brand loyalty maybe.
They certainly are, but building an EV business isn't just about the car itself. It's about building the whole ecosystem around it. So they're putting significant focus on expanding charging infrastructure through partnerships like GM Energy and Iona. Their goal is ambitious, aiming for 65,000 public fast charging bays by the end of this year, growing to 100,000 by the end of 2027. Despite that slower EV industry growth overall, their North Star, their guiding principle, remains profitable EV production.
And how are they actually tackling that profitability challenge specifically? Because that's been tough for everyone.
Yeah, it has. Well, they're investing heavily in new battery chemistries, things like LMR, that's lithium magnesium rich, and LFP, lithium iron phosphate, through their Ultium Cells joint ventures. These are absolutely crucial for driving down costs. They actually believe the potential for even greater cost savings from LMR and large truck packs might even beat what they can get with LFP, at least at today's metal prices. Plus, they're doing the other stuff, making vehicles lighter, more aerodynamic, standardizing components wherever possible to boost EV efficiency and profitability. It's really a multi-pronged attack on cost. It's also important to note they did address a $600 million lower of cost or market adjustment on their EV inventory. This is essentially an accounting move. They're writing down the value of those EVs on their books because they think future sales pressure might mean selling them at a lower price. It's a pretty clear signal of the current challenges in the broader EV market, right? But they do expect the situation to improve over time as inventory levels kind of normalize. GM is making it really clear that their EV journey is about giving consumers choice across different price points, from luxury down to affordable vehicles, while staying focused on a clear path to profitability for each one.
Right. And beyond the vehicles themselves, GM is also making these significant strides in software and services. Their Super Cruise tech, for example, that expanding rapidly, now on 23 models.
Yeah, 23 models. They expect to have 600,000 customers using it by year end. And crucially, each of those customers has paid upfront for 3 years of service. That's projected to bring in over $200 million in Super Cruise revenue in 2025 alone, and it's expected to more than double in 2026.
So this $4 billion in deferred revenue from Super Cruise, OnStar, other software that's not just pocket changes, it signals a pretty massive shift in how they monetize their vehicles over their whole life cycle. Can you maybe unpack how significant this recurring revenue stream is for a traditional automaker?
Precisely. Yeah, it's huge. That $4 billion in deferred revenue means they've already got the cash for services they'll deliver over time. It's like having a subscription service baked into every car sale now. It's a really robust future revenue stream, totally transforming how they view making money beyond just that initial vehicle sale. Plus, their new MyGM Rewards loyalty program that's driving higher MSRP purchases and more frequent service visits. It shows a deeper, kind of stickier engagement with their customer base. It's creating this continuous relationship and additional revenue opportunities long after the car leaves the dealership lot. And this focus on technology, it extends really deeply into their team and overall strategy. They're bringing in tech innovators like Sterling Anderson. He co-founded Aurora, the autonomous trucking company. He's now GM's chief product officer. They're also embracing AI across the entire company, or recruiting Barak Taraski, a veteran from Google and Cisco, to lead their AI efforts. This isn't just about, putting AI in cars. It's about using intelligence to redefine vehicle performance, improve the customer experience, and boost operational excellence everywhere.
And that innovation seems to be spinning off entirely new business opportunities beyond just selling cars, too.
It absolutely is. Think about this. GM Second Life EV batteries are being repurposed through a partnership with Redwood Materials, giving old batteries a new life in energy storage. And what's really forward-looking, I think, is they're finalizing an agreement to supply battery modules to Redwood Energy, their aim, to meet the surging power demand from AI data centers. It's a very clever way to monetize their battery assets long after they're done in the vehicle.
But innovation isn't always smooth sailing, right? We also saw that warranty expenses increased by $300 million in Q2, primarily due to some LED7 engine issues and some software glitches on early EV launches. How are they addressing those kinds of challenges?
Yeah, warranty expenses are always something to watch, but management is actively addressing these root causes. They're using supplier quality improvement programs, enhanced diagnostics, over-the-air updates for software fixes. They're aiming for stabilization in the second half of the year. They're also really emphasizing these winning with simplicity initiatives. Think of it as streamlining processes, reducing complexity in vehicle design, standardizing parts where it makes sense. This directly supports better launch quality and manufacturing efficiency right across the board. It's really about getting things right the first time, consistently.
Okay. And finally, let's quickly touch on capital allocation and shareholder returns. Their annual capital spending outlook seems consistent. $10–11 billion for 2025, then $10–12 billion for 26–27, and these strategic investments are being offset by cost efficiencies, they say. They've also maintained a strong balance sheet, even while issuing $2 billion in debt, partly for that early repayment of the Ultium Cells DOE loan. This consistent approach to spending, combined with the share buybacks, it underscores a pretty disciplined financial strategy overall.
Yeah, and if we sort of connect all these pieces to the bigger picture, it becomes pretty clear that GM is playing a sophisticated game here. Their financial performance, even with those significant tariff headwinds, it really highlights the fundamental strength of their North American operations. The fact that their margin would have been 9% without that tariff impact, right in their target range, that truly speaks volumes, I think, about the underlying health of their core business. They are absolutely leveraging their highly profitable ICE business to fund future EV and tech investments, which is a strategically sound move, especially as the EV market sees slower growth and, changing incentives. Their commitment to expanding U.S. manufacturing and domestic supply chains, that's a key differentiator against tariff impacts and shifting trade policies. It creates long-term resilience and flexibility.
Right. And that focus on software and services with that growing deferred revenue pot, it really does suggest a robust future revenue stream beyond just selling cars. This highlights a pretty fundamental shift in how they view monetization throughout the vehicle's entire life, extending way beyond the initial purchase. They're effectively building a whole new economic layer on top of their established hardware business. It's an interesting move for a company so deeply rooted in physical manufacturing, isn't it?
It really is. And this kind of raises an important question for you as a listener, perhaps. In a world that's often hyper-focused on pure-play EV companies and their rapid growth, does GM's more balanced approach, coupled with these significant investments in battery tech, software, and flexible manufacturing, offer a more resilient and ultimately more profitable path? They seem to be consciously choosing to offer consumer choice and adapt their production to actual market demand rather than just chasing unit volume in what's become a more volatile EV market. Their long-term strategy seems to be about sustainable, profitable growth across all the segments they serve, which is frankly something many pure plays are still struggling to achieve.
Okay. Now, for the segment where we stretch the bounds of plausible just a little bit. This is not financial advice, just a thought experiment for the adventurous investor out there.
All right, so given everything we've just discussed, particularly GM's strategy of maintaining a strong, profitable ICE business while making this deliberate, cost-focused push into profitable EVs with flexible manufacturing. Here's an outrageous but maybe plausible trade idea. How about implementing a pair trade? Go long General Motors, so buy GM stock, and simultaneously short a pure-play, high-valuation EV manufacturer, one that's currently struggling with profitability and maybe heavily reliant on government credits.
Okay, interesting. So you're essentially betting on the old guard outmaneuvering the new guard in a more mature, maybe more rational market. Tell us a bit more about the thesis there.
Exactly. Yeah, the thesis is basically that the market might still be excessively discounting legacy automakers like GM, kind of treating them as if they're stuck in the past, while potentially overvaluing some EV pure plays that lack the diversified revenue streams, the established dealer networks, and critically, the manufacturing flexibility that GM is now explicitly leveraging. You're essentially betting on GM's all-of-the-above profitable strategy outperforming a more concentrated, maybe subsidy-dependent EV-only model in a, let's say, more rational post-incentive market environment. This trade is really predicated on the market eventually reevaluating the true costs and the actual path to profitability for EVs, and finally recognizing the underestimated resilience and earnings power of a company like GM that can actually pivot between ICE and EV demand based on reality. It's sort of betting on adaptability and a proven business model over maybe pure, sometimes unprofitable ambition.
That was a truly insightful deep dive into General Motors' latest earnings. It's definitely clear they're navigating some complex market shifts with a strategic and disciplined approach.
Indeed. Yeah, their emphasis on manufacturing flexibility, cost-efficient battery tech, and leveraging that strong ICE business really does set them up uniquely, I think, for the coming years. Keep a close eye on how these investments in domestic capacity and these new tech chemistries actually translate into sustained, robust profitability rather than just, chasing market share.
We certainly hope this deep dive has provided you with some actionable insights and maybe sparked some new perspectives. What aspects of GM's strategy stood out most to you from today's discussion? We'd genuinely love to hear your thoughts.
And just remember, of course, this information is purely for educational purposes. It is not financial advice. Always, always do your own due diligence before making any investment decisions.
Thanks for tuning into the deep dive. We'll be back soon with another in-depth look at the numbers. Until then, keep digging into those figures.